How far back can CRA audit a non-resident business? When a US business starts selling into Canada, one of the first worries is how far back the Canada Revenue Agency, CRA, can look if they decide to audit. This is not just a technical question. It affects how long you keep records, how you handle past issues, and how you plan your expansion strategy. The short answer is that CRA usually focuses on a limited number of recent years, but that comfort disappears quickly if returns were never filed or if CRA believes something serious went wrong. Understanding the basic rules around reassessment and audit periods helps non-resident businesses manage risk and avoid surprises. The normal reassessment period. CRA generally works with what is called a normal reassessment period. This is the standard window of time during which CRA can review a filed return and change the tax owing. For many corporations, including foreign-owned companies with Canadian filings, the normal reassessment period for income tax is several years from the date of the original assessment. For GST, HST, the reassessment period is also based on the filing due date and the date the return was filed. Within that period, CRA can examine your records, adjust your net tax, and reassess amounts due. What this means in practice is simple. If your US company is properly registered, filing on time, and generally compliant, CRA usually looks at a recent slice of your activity. Think in terms of a few years, not decades, as the default audit horizon. When CRA can go back further. Here is where things get more serious. The normal reassessment period is not an absolute barrier. CRA can go beyond it in specific situations. The key concept is misrepresentation. If CRA believes a return is misleading because of neglect, carelessness, or willful default, it can reopen earlier years. It does not have to prove full-blown fraud. A pattern of underreporting, missing income, or unsupported claims can be enough. In cases of actual fraud, CRA's reach can be even longer. When CRA believes there was intentional deception, older years that would normally be closed can become open again for review and reassessment. There is also the issue of waivers. Sometimes a business signs a waiver to give CRA more time to review a specific return or issue. Once you sign a waiver, CRA can reassess beyond the normal period for the matters covered by that waiver. This is common in complex audits where both sides need more time to resolve questions. Unfiled returns when the clock never starts. Here is the part that matters most for many non-resident businesses. The reassessment clock does not start unless a return is filed. If your US company was required to register for GST, HST, or to file Canadian income tax returns and simply did nothing, there is no normal period running for those years. Imagine you started selling to Canadian customers 4 or 5 years ago. At some point, you crossed the GST, HST small supplier threshold or triggered registration under the digital economy rules, but you never registered and never filed a return. From CRA's perspective, those years are not closed. If CRA discovers the problem, it can assess tax, interest, and penalties all the way back to when the obligation began. This is why ignoring Canadian filing obligations is so dangerous. Late filing at least starts the clock. Non-filing leaves everything open indefinitely. Audit period versus collection period. Another concept that often gets mixed up is the difference between reassessment periods and collection periods. The reassessment rules determine how far back CRA can go to change the tax owing. The collection rules determine how long CRA can enforce payment once a tax debt has been assessed. Once CRA issues an assessment, a separate limitation period governs how long it can take legal steps to collect. This period can be reset by certain actions, such as making a payment, entering a payment plan, or acknowledging the debt. For a non-resident business, this means you could be reassessed for older years and then face a second separate timeline for collections. In short, one clock controls how long CRA can adjust the numbers. Another clock controls how long it can chase the money. Record-keeping expectations for non-resident businesses. Any audit comes down to one thing: records. CRA expects every business, including non-resident companies, to maintain proper books and records that support everything filed in Canada. That means invoices, receipts, contracts, import and shipping documents, bank records, accounting ledgers, and any working papers used to prepare returns. As a general rule, records should be kept for at least 6 years from the end of the tax year to which they relate. Many advisors suggest keeping them for 7 years or longer, especially for cross-border operations or real estate and large capital projects. Since non-resident businesses often keep records outside Canada, CRA may require that records be made available in Canada or electronically in a way that auditors can review. If your structure involves multiple entities or platforms, you also need to be able to show clearly which entity made which supplies, where customers are located, and how revenue and tax were handled. That level of clarity can make the difference between a routine audit and a painful one. A practical example for US sellers. Picture a US e-commerce brand that began selling directly to Canadian customers through its website and a marketplace. In year 2, Canadian sales quietly passed the small supplier threshold, but nobody on the team realized this triggered GST, HST registration. No registration was done and no returns were filed. 4 years later, CRA picks up the trail through customs data, payment processor information, or marketplace reports. Since no returns were filed, CRA is not limited to a short lookback. It can reconstruct several years of Canadian sales, assess GST, HST on those amounts, add interest, and apply penalties for failure to register and file. If the same business had registered on time and filed honestly, CRA would usually be confined to a much shorter reassessment period. The example shows a simple rule. Dealing with registration early usually shrinks your long-term audit risk. Managing CRA audit risk as a non-resident. You cannot eliminate CRA audit risk, but you can make it manageable. For US businesses, that usually means understanding when registration is required, filing consistently once you are registered, reporting accurately, and keeping records long enough to cover CRA's practical lookback. If you discover that you should have registered earlier or that returns were missed, you may want to explore voluntary disclosure options rather than waiting for CRA to take the first step. This kind of proactive approach can sometimes reduce penalties and help you reset your Canadian tax profile in a cleaner way. Final thoughts? For most compliant non-resident businesses, CRA's practical audit reach is focused on a handful of recent years. That changes quickly when returns are missing or when CRA believes there were serious misstatements. If you are selling from the US into Canada, assume CRA can review several years of activity and plan your record keeping around that reality. The safest path is straightforward. Register when required, file every return, and keep documentation for longer than the legal minimum. That way, if CRA ever decides to look back, you are ready. If you would like more straightforward explanations on CRA accounts, GST, HST registration, and cross-border compliance for US businesses, you can explore our website for additional guidance. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.